Welcome to this podcast organized by EFRAG, European Financial Reporting Advisory Group. My name is Sedat, Communication and Media Manager at EFRAG, and I will host this podcast. In this first episode, in a series of 4, we will explain and discuss the purpose and process for a post-implementation review. Today, to discuss this topic, I have with me Sedat Saritas, who is an IFRS manager at EFRAG. He will provide his view and experience with post-implementation reviews. Just to give an overview of the entire series, the second podcast will relate to the PIR of IFRS 10, Consolidated Financial Statements. The third podcast will be on the PIR of IFRS 11, Joint Arrangements, and the fourth will be on the post-implementation review of IFRS 12, Disclosure of interests in other entities. As these IFRS standards are closely linked, we invite you to listen to the full podcast series just to have the complete image. Now, Sedat, can you first explain to us what a post-implementation review is?
Yes, Cecile, sure. The post-implementation review is part of the IASB's maintenance program and basically ensures that issued amendments and new standards work as planned. This review is very important, and EFRAG supports the need for post-implementation reviews. A PIR has 2 phases. The first phase involves an initial identification and assessment of the matters to be examined. These items are then the subject of the second phase, which is a public consultation in the form of a request for information. In the second phase, the IASB considers the comments received along with information gathered through other consultative activities. Based on that information, the IASB presents its findings and, if applicable, sets out the steps it plans to take. The current series of podcasts that you have referred to in the introduction are part of EFRAG's response to the second phase of the project. They are designed to assist stakeholders in providing responses to the request for information.
So, basically, the PIR is an opportunity to evaluate whether the arguments and views taken into account in the standard setting process were realized as expected. So a possible analogy could be sort of speak now or remain silent forever. But Sedat, could you explain why this evaluation is important for stakeholders?
Yes, and your statement is correct. During the public consultation of an amendment or a new standard, many stakeholders express views and provide evidence to support their views. EFRAG participates actively in this process by conducting its own research and seeking input from constituents before making recommendations to the IASB. Then the IASB considers all the input received from stakeholders and aims for useful financial information which can be produced without undue cost or effort. In reality, however, it is possible that amendments or new standards do not fully work as expected, or there may be other issues, for example, relating to the implementation, where obtaining the information necessary turns out to be more complex and costly than expected. Another issue could be that due to developments in the market, certain information is not useful anymore for the users of financial statements. In any case, the post-implementation review gives the stakeholders the opportunity to evaluate the effectiveness and efficiency of the amendments and/or new standards.
So, developing IFRS standards is indeed challenging, and there are many stakeholders with divergent views, specifically due to different sectoral backgrounds, organizational structure, size, etc. It is very interesting to have stakeholders' feedback on previously amended or issued standards. So, Sedat, could you elaborate a bit more on the examples in practice where the PIR turned out valuable to users and preparers, and how the PIR is organized by EFRAG?
Yeah, a good and very interesting recent example of a PIR is the one on IFRS 3 business combinations. I will not go into the technicalities here, but the PIR on IFRS 3 clearly showed, especially from the point of view of investors, that the current information in the financial statements were not sufficient to judge the subsequent performance of acquisitions. and were also not sufficient to hold management to account for their decisions. Other issues were identified by preparers and other stakeholders in relation to the effectiveness and efficiency of the current subsequent accounting for goodwill. As a result, the ISB has started a standard setting process to review and amend IFRS 3. In this way, IFRS 3 is further fine-tuned to result in useful financial information for users, which can be produced and disclosed without undue cost or effort for preparers. However, not all post-implementation reviews will lead to standard setting. It might be possible that the PIR shows that the reviewed standard or amendment is working as planned and that there are no major issues. For example, the PIR of IFRS 13, fair value measurement, did not lead to specific standard setting activities, although the lessons learned, of course, were fed into other projects. I also want to emphasize that, in general, it is very important that all stakeholders express their views. As users, preparers, auditors, standard setters, regulators, academics, and the list can be much longer, of course, all have a different point of view and can highlight different important aspects that need to be taken into account when reviewing an amendment or standard. EFRAG uses different tools to communicate with constituents and obtain information for the purpose of a PIR. For example, an important tool is a questionnaire, which is very efficient and effective to use. And finally, next to questionnaires, EFRAG also performs field tests, interviews, and organizes public events.
Thank you, Sedat, for sharing your experience with us on post-implementation reviews. As mentioned in the introduction of this podcast, EFRAG has started a post-implementation review on IFRS 10, 11, and 12. The link to the questionnaire related to the PIR can be found on EFRAG website. We invite you to join us on the next 3 podcasts, this time related to, as explained just before, IFRS 10, 11, and 12. Thank you for joining us.